Run it. I can't take no loss. I don't even know what it costs. I hit the ground, then it go off. Yeah, hit the ground, then it go off. Yeah, I can't take no loss.
All right, folks, welcome back to another edition of Hoojie Trades. Let's talk about it, man. We had FOMC today. We had CPI yesterday. A little bit better number than expected, but I think we're beyond that actually mattering now. We did come up. We rejected at the top of this volume gap. Rejected it back down, and it doesn't look like the market really wants to head back up there after Powell spoke today. So there's still an opportunity to, catch some long side on some day trades, but now, we're going to start to look for that big downside move into next year. We definitely want to be looking at a long time frame here because, like I said, we could still go up and try to retest that high that we made yesterday. So, I'm just looking at this from we've been in a balance now for over a month. So this is the flattest we've been all year. If you go back to the entire year of this market, the SPX and Qs have been just balancing now for a month, and we've been stuck in this range. And we had a failed breakout yesterday, and obviously today, during the speech, it got taken back down, but we ended up just basically being flat. So it's just been a nightmare for swing traders, these last couple weeks, especially, if you're looking for a big move either direction, which we ended up not getting. And it's not surprising because nothing's really changed. Fed's still saying the same things they've been saying all year. We are, as much as they don't want to admit to it, we are looking at a recession next year. Things are not getting better. Inflation might be coming down a little bit, but there's other problems outside of that. We have a credit crisis. Unemployment's going to get bad. The housing market can get worse. So anyone's been paying attention knows that we're kind of headed into no man's land right here because we're not going to see all-time highs for a very long time at this rate, in my opinion. So, let's look at the charts and see what we got. Let's see what we can come up with. Look at some action. Remember, we got quad witching this week as well. All right, so let's get the details of this chart, and I'll show you exactly what I'm talking about. Since I use volume profile, you can zoom in a little bit and see it a little bit closer here. But you can see right here, this volume gap, right from here to here. We got it from 397.60 on SPY up to about 410.81. And then if you're looking at SPX, very similar. We got to come here SPX because we still want that gap fill up at 42.20, which we could still see. That's definitely still a possibility into the end of the year because right now, we're back to looking short, but we also have to keep in mind that we're in a time of year where the market does like to move up. These last couple weeks of the year tend to be good weeks for trading to the upside. So that's why we want to keep in mind that we could still rally this thing before tax harvesting begins and people start selling off. But you can see this volume gap, and we also double top. So you can see the double top. You can see the volume gap over here in the volume profile. And then also, when you look at the 15-minute volume profile over the last couple of days of intraday action here, that might be easier to see on the hourly. Let's see. No, it's not as good as you can see it yesterday on the volume profile. Yeah, this is a little better. But you can see when we were up here, it was nothing but selling. See, that's what all the yellow is here on the volume profile. We just saw a little bit of buying, trying to save it down here. Saw a little bit, very little here as well. But overall, the yellow is the downward pressure, and there was a lot more of that. Same goes for over here. So you can see the downward pressure here on this breakdown. Up here, there was a lot of buying up here today. We built some value up here intraday. But when Powell started speaking, of course, we brought it back down to 4,000. 4,000 ended up being a great buy. It's about 39, 39.80, 39.85 on SPX. That was 4,000 now on futures because obviously we rolled the contracts over to March contracts on futures now, so we did get that 30-point move difference in futures contracts, which is kind of confusing for some people because if you look at ES on the futures, we're at 40.32 even though we're at 4,000 on SPX. So once again, as I've talked about before, we have that 30-point difference now for the futures contracts to SPX. But yeah, overall, it's just looking like the market's kind of getting toppy. It's definitely toppy. That's a big rejection up here. We got up over 4,100. It was 4,180 that hit on ES. I mean, it hit 4,180 in the pre-market, so that's why you don't see that on SPX. But it was just, it was straight selling after that. And we stayed in the balance. Like I said, you look at the hourly. Look how long we've been in this balance. Since 10th of November. I mean, this is just, this range from 4,100 down to basically 3,900. That's the longest period of time we've spent in any type of range this year. I mean, you can just look at the chart and see. Like, when else have we spent that much time in a 200-point range? It's been a volatile year, so, yep. Definitely the longest we've spent in a 200-point range. But yeah, I mean, I would love a push up to that 42.20, that gap target up here. You can see back from here in August, we had that gap down, and we've never refilled that. So if we go get that, I think that could be the ultimate short. But obviously, I want to start looking short now because, we're failing to break out of this channel. And we had the double top, and we clearly didn't want it back today. We tried to, push up today, but we didn't want no part of getting all the way up there. And obviously, the speech affected the market and brought it back down. And we're kind of in the middle of the balance again now. So definitely with quad witching on Friday, there's going to be some screwery going on. So we got to keep an eye on that. We got to be smart when we're out here trading this market. Because it's hard telling. Institutions are starting to hedge. I've seen a lot of freaking dealer hedging going into the new year. So, I mean, if we're getting short, if you're not shorting shares and you're buying puts, you just definitely want to be buying time. That's why I've been looking at Junes now for next year. I think that should be enough time as long as you're not playing super extremely far out of the money. I think that's safe because it's just, like I said, it's hard telling. You might have to sit through being down on those puts. So you got to make sure that you have the account size in order to play those long-term puts and be able to sit through them drawing down because they can draw down, 20, 30% if we go up to 42.20 and you're going to have to want to sit through that. Or you're going to want to just kind of wait it out. But if you wait it out and then we start moving down, I mean, this trend can happen fast. So that's why, you want exposure, in my opinion, to the downside. I'm not your financial advisor or anything, but that's just how I trade. Like, I want to get exposure because, nobody can predict exactly what the market's going to do. As much as I want to see 42.20, we've hit, the majority of my targets since I started getting long at 35.20 and 3600. I mean, that's where I've been long from. So, when we caught, I trimmed a lot of this. I mean, at 4,000, 4,100, 4,170. And, now I'm basically just letting runners go to see if I can hit my ultimate 42.20 target. And I don't have very many of those left. I closed most of my calls today. So if you're on the Discord, of course, check us out, Bullprint. Always check that link in the description of my videos or on my bio. You can get the 2-week free trial. We got 3 charting sessions a week, 5 great analysts. Be sure to check that out. Always, don't forget to like and subscribe to my YouTube as well. I'm going to start getting some more videos out. I had a little break because I haven't been feeling too well, but I'm back. And I've been on Twitter posting a lot too, so make sure you follow me on Twitter at HoogieBoy, Hoogie Trades, at HoogieBoy. Check me out on Twitter. And also, like I said, we're looking for this downside. I mean, so that's all I can say at this point because we clearly failed now twice up here. If we go retest it again, I would almost bet that we're going to fail it again. That's a key level right now. That 4,100 level is just not one to break through. I mean, it's really 4,105 on SPX if you want to, be exact numbers, but any pop over 4,100 is going to be a short until they tell me it's not. And in that case, I'll grab some time on those puts, and I'll wait for that 42.20 in case that does happen in the end of the year. But I don't think we're going no higher than that. I mean, we might fake some people out and get out of this channel for a brief period, but this market is due to come back down. I mean, Powell didn't say nothing different today other than inflation's coming back down. But inflation is not our only problem. There's all kinds of other things that can break if they don't get this right. I mean, inflation is not the only problem. And I think the market's kind of only thinking about inflation right now, but there's a lot more to think about that's going wrong with this economy under the Biden administration and Fed Chair Jerome Powell. So if they're overlooking something, which is definitely possible because it wouldn't be the first time it's happened to the Fed, then we need to be aware of that and be cautious of that. I don't think this market looks healthy at all, or else we would be pushing, to test these August highs over the last couple weeks. But instead, we've been stuck in this balance and unable to break out over 4,100 with any type of strength at all. And we kind of saw this back here too. When we were in this balance back in June, I know we were struggling up here, and then finally look what happened. Boom. Flushy time. We need to be prepared for that, especially with tax harvesting coming up at the end of the year. People are going to start selling, trying to take those losses and use them for their tax write-offs. So, that's kind of what I'm looking for into the end of the year. But obviously, the next 2 weeks, we need to be cautious of getting long. And we can do that for day trades. And I will be sending those alerts in the Discord, so be sure to check it out. But other than that, I definitely want to be on, if I'm swinging anything, it's going to be shorts at this point. I want to make that as clear as possible. So that's what I'm looking at on that. And also Tesla. So come to find out, I just got news that Elon did sell some more stock in the last couple days. The form came out. And so Tesla has sold off now. It's back down at 156.90. New lows for the year. We're now down 55% on the year. And the chances of this thing getting saved are pretty slim until we hit 150, because we do have that volume gap on the daily. I'll show you if we can get it zoomed in here. We've been kind of waiting, trying to be patient and waiting for this. Yeah, so you can see we've been in this volume gap from 195. It goes all the way down to like 150, 125. So you can see I've got my zone here that I'm looking at. I've been adding shares. I'm not adding options down here, but I probably might try some options off 150, 125, somewhere in this area here, down to like 145.54. Because you can see this this volume shelf here, we could pick it up. So you can see some buying volume. We might see them definitely trying to save it down in here. We still, since we are in a volume gap, we can move back up too. So now that everyone knows that Elon's sold and it's not just the Twitter, maybe we could see some buying into the end of the week. So I'll be watching this for a bounce as well tomorrow. This is definitely one we want to keep an eye on for either direction, because it sold off so much that if we get any type of strength out of the market, I think Tesla can really start bouncing to the upside, especially now that we know Elon did sell the stock. It was like another $3 billion, but he still owns a ton of Tesla shares. And everyone takes this as bad news. It's really not bad news, because he owns so many shares that it's really not going to affect anything long term. Tesla is one of my favorite plays long term. Like I said, once again, I'm not your financial advisor, but it's something that I want to hold in my port for the very long term, and even hand some of it down to my kids, whatever I don't sell, because I do hold quite a bit of equity. So this is one I definitely want to keep in the port. And out of all of tech, Tesla is one of my favorites to outperform most other tech names in the next couple years while we're in a slowdown. So I think any type of good news right now could just send Tesla off to the races again. Apple's one I'm looking at. It looks like it's ready to break down again. I think this thing has to come see 130. It's tried to remain strong, and it takes a lot of people selling this thing to bring it down. But you can see, like, even on the fib chart, I've been using the fib chart on Apple, because you can see it's respected these two fib levels between 152.60 and 133.69. I mean, we've just been in this range, basically another balance right between the two fib levels here. So this one, when you watch this 133.69 down here, because if we do sell off into that, we'll probably see a short-term bounce off that as well. But I do expect Apple in the next year to come down and hit this 118.42, possibly even this 103.14. I think it's got a way to down. If it comes down and hits this 103.14, you can see there's a big old volume gap here to take it all the way down to 97.50. And really, honestly, I think that's kind of where Apple belongs. I think it's still overvalued up here. It takes a lot of, because it's such a big company, it takes so many people selling to bring this price down, and people have viewed it as a safety net up until now. But I think with some of the China issues and everything, and demand is slowing down, I think we could see a little bit of selling on Apple and try to bring this thing back down to a reasonable price. And if we do come down, close to $100, I'll definitely start buying Apple again. I think it's a good buy down there. So that's kind of what I'm looking at. But I do expect this thing to break down, and we should see that 133.69 in the fairly near future. But that's something that I would still, if I'm going to play puts on it, I would want to buy, March, April, May, June's. I want to play with some time. I'm not really much of the guy that wants to short, with a couple weeks out. That's, I want to give myself time for the move to make. I want to see my puts get in the money and possibly deep in the money if I get the move I'm looking for. So that's why I like playing with time and letting them ride out. I can sit through a little bit of bounces and possibly average in. That's my style of trading. Now I do some day trades as well, and there could be some opportunities on Apple for day trades as well. But normally when I'm doing day trades, I kind of stick to SPX just because it's, you can make a little bit more money off of it, but those are definitely more expensive contracts to play. So anytime if you're following me and I'm trading SPX, you could trade SPY yourself. That's a good way to do it. So that's kind of what I'm looking at on Apple. All right, and then finally, I wanted to talk about this news release on SEC proposes biggest trading reforms in decades. I mean, this could definitely change the game a little bit on how retail trades. So let's go over the article and see what they're talking about here. The Securities and Exchange Commission on Wednesday proposed changes in how stocks should trade, which represents the most far-reaching shakeup of Wall Street's foundation in decades. The proposals largely reflect provocative ideas floated 6 months ago by SEC Chair Gary Gensler. Intended to boost competition and benefit small traders, the ideas embodied in the rules have not been popular with some in the trading establishment, but Gensler's 3-2 majority of Democrat commissioners will likely adopt the proposals and put them out for what's sure to be raucous public comment. While the new rules don't include a ban on order flow payments, which subsidize the interest commission-free trading, some of the proposed rules could threaten the key role now played by half a dozen market makers, including Citadel Securities and Virtu Financial, in completing the trades of individual investors. Virtu shares dropped 7% to $20.40. The S&P was down 0.5%. All right, so now we're talking about payment for order flow, which, the apes talked a lot about this during the AMC and GME squeeze. So there's been constant, they've all wanted a ban on payment for order flow, which, I kind of understand because they're worried about dark pools and things of that nature. So retail stockbrokers like Charles Schwab and the E-Trade unit of Morgan Stanley send most small orders for execution by those computerized wholesale market makers. One of today's 5 proposals calls for the creation of a new auction process where dealers would compete to execute individuals' orders. The rule would require stockbrokers and the wholesale market makers to submit to auction orders sent by an individual seeking to buy or sell stock at whatever is the currently quoted price, a so-called marketable order, as long as the trade totals less than 200,000 and an individual averaged fewer than 40 orders a day in the previous 6 months. Only if the auction finds no match would the wholesaler complete the trade internally, as it does with most retail trades today. In his prepared remarks, Gensler said the competitive auctions could save retail traders as much as $1.5 billion a year by getting them better pricing on their trades. There isn't a level playing field among different parts of the market, Gensler said. Wholesalers operate in the dark market, which I was just speaking of. Industry forums have criticized the feasibility of order-by-order auctions, warning that small traders would get worse results than those provided by today's market structure. Virtu offered no comment on SEC's proposed rules. Citadel Securities issued a skeptical statement. Over the past 20 years, competition, innovation, and thoughtful regulation have saved retail investors billions of dollars by increasing access and transparency and significantly lowering trading costs, said Citadel Securities. The U.S. equity market is the envy of the world, and any proposed changes must provide demonstrable solutions to real problems while avoiding unintended consequences that will hurt American investors. And that's true. As much as I do want to see some changes, and I do feel, not retail doesn't have it obviously as easy as, market makers do when it comes to this, the trading in the financial markets. But at the end of the day, we don't want them to make changes that could end up affecting us negatively either. I mean, I like the way I'm making money now. I don't want nothing to get screwed with and it go the other direction either, which can happen. If they start tooling around with things, they could still mess up trading for retail traders worse than what it already is. So we need to be cautious of what we're asking for here, in my opinion. Wednesday's auction rule also drew criticism from institutional broker Liquidnet, which said the SEC provided few details to support its claim the auction could save $1.5 billion. Why have the details been so few? Asked Liquidnet's head of American's market structure, Jeff O'Connor. And why do industry participants feel like they haven't been properly included in analysis? Another proposed rule would allow stock exchanges to execute trades at price increments smaller than the 1 cent moves to which they are limited under current rules. The off-exchange market makers have no such constraints, and one reason they have gained over 40% of order volumes is their freedom to execute trades at prices that are fractions of a penny better than the exchange prices. With the current penny increments for all stocks, the U.S. markets have lagged behind bourses in places like Europe, where price moves or tick sizes can adjust dynamically with the stock's price to allow narrower spreads between bid and ask quotes when liquidity allows. The new SEC rule would allow tick sizes to vary from 1/10% to 2/10 to half a cent and a penny, as the quoted spread on a stock narrows or widens. Harmonizing the tick sizes would help level the playing field between and among the dark and lit markets, said Gensler. Upstart exchange operator IEX Group welcomed the leveling proposals. We believe the reforms announced by the SEC represent a constructive and positive effort to improve transparency, increase competition, and ensure that investors can access the best prices available in the market, said IEX President and co-founder Ronan Ryan. Modernizing regulation ensures that market competition among brokers, market makers, and exchanges continues to benefit investors. While allowing exchanges to quote and trade more competitively with the wholesalers, the small tick size will also impact the fees and rebates that exchanges currently use to attract liquidity. The same proposed rule would change America's 100-year-old conventions for bundling stock trades in round lots of 100 shares. Individuals today trade many stocks in odd lots of fewer than 100 shares, but those orders and trades haven't been reflected in nationally quoted prices. The rule would do away with these old distinctions on an accelerated timetable. The Hedge Fund Industry Group Managed Funds Association applauded these pricing changes. We are pleased to see that the SEC is addressing minimum pricing increments, tick size, access fee caps, and transparency of better priced orders, said MFA Chief Executive Brian Corbett. We look forward to carefully reviewing the full slate of proposals and working constructively with the SEC to calibrate these rules to best serve investors and avoid unintended negative consequences. So there, we are getting both sides of the story here. So there is a side that does believe this could be better for markets, and there is a side that thinks it could be negative. Obviously, Citadel, I don't really trust them too much. Obviously, we don't trust the hedge funds. We don't want to trust these hedge funds because obviously they're looking out for them and their billions of dollars. So, I tend to agree with this side, and maybe it is going to be better for traders. But we'll have to, it's something that we're going to have to wait and see, take a wait and see approach to. We'll see, once they start doing it, once they do implement it, we'll see how it goes. And if it is better, then that's that, hopefully it works out. But anyway, Trading Industry Group Securities, Industries, and Financial Markets, or SIFMA, also issued a statement on Wednesday's proposals. The U.S. equity markets are incredibly efficient and resilient, and investors, especially retail investors, have the greatest ease of access, lowest cost of trading, and best execution in history, said SIFMA Chief Executive Kenneth Benson Jr. We strongly believe the SEC needs to be extremely careful in its approach. Any changes being proposed in the name of competition may tilt the playing field at the expense of investors should be weighed carefully, be subject to a robust cost-benefit analysis, and considered holistically with a view to ensuring there are no negative unintended consequences for investors. One much-debated idea since I've heard of Wednesday's proposal is an outright ban on payments made by market makers to induce brokers to send retail order flow. Instead, the agency proposed standards for best execution that brokers must heed. Brokers will have to disclose how they measure and obtain the best prices and speedy trades for their customers to justify the broker's receipt of any order flow payments. I like that, and I see why they don't like it. When I stated that the Securities Exchange Commission shortly after the meme stock events, I asked a colleague to provide a copy of our best execution rule, said Gensler. I was surprised to learn the SEC didn't actually have its own best execution rule. The agency will seek to update Wall Street's reporting on how well retail customers' trades are executed. As Barron's reported, market makers are required to report on the pricing they provide on customer trades, but stockbrokers aren't. There is widespread support for the SEC to standardize execution quality of reporting by brokers. Another proposed rule will constrain the trading of company executives who use stock trading plans as a safe harbor to avoid insider trading liability. Research has shown that insiders can use non-public information under current plans. Whatever rules the SEC adopts on Wednesday will be put out for public comment. Some SEC comment periods have been as short as 30 days, but Gensler's market structure ideas have drawn industry criticism, so the agency will allow 60 days after its proposals appear in the Federal Register. The SEC would then spend about 6 months digesting the feedback before issuing the final rules sometime in the latter half of 2023. So this is something that we're not going to see until, next July, August, maybe later, knowing, the SEC. So it's not something that we're going to see real soon, but it is something that will be talked about over the next 6 to 8 months. That is when any changes to today's trading will likely face a court challenge by industry incumbents. Every major change to market structure proposed by the agency in the last 10 years has ended up in court. Virtu already sued the agency in federal court seeking freedom of information disclosure of SEC records on its market structure plans. So yeah. So let's go down some comments down here and see what they're saying. Let's see what they got. I kind of agree with this guy. Sounds good on the surface, but things are not always what they appear to be. Changes like this make me nervous. Does anyone else feel uneasy about changes like this being made right now? So I'm kind of feeling Douglas Anderson down here. You know, it kind of sounds good on the surface, but you don't know until we start executing that way. So yeah, let me know in the comments what you think about this story and what you think. What do you think we need to do in order to make it more fair for retail traders in the current market? As always, you know, that's what I got for this video. I gave you some levels to watch on SPX. We talked a little bit about Tesla and its possible downside, Apple and its possible downside. And I wanted to definitely talk about this because this was big news today. Possible major change in how we trade in the stock market and where our trades are executed through and how they're executed. So yeah, please leave any questions and comments. Any type of proposals or things you would like to see in the market change. Leave those in the comments. Also, let me know what you want to see in my next video. I'd love to make videos based on what people want to see right now. So let me know that. Smash that like and subscribe button. As always, you know, I appreciate y'all for watching. Check us out on the Discord. I love y'all. Peace.